Sears announced today that it is considering options for both its Lands' End apparel brand and for its Auto Centers unit. Joining me is Antony Karabus, president of Hilco Retail Consulting. Thanks for joining me, Antony.
My pleasure, Richard.
So today, Sears announced that it is looking at spinning off both Lands' End and its Auto Centers. Can you discuss this a little bit? I mean, this is a continuation of a liquidation of Sears.
Yeah, I think this is could be described as a war of attrition. I think what's really happening is Sears is gradually selling off the pieces that have real value, as well as some of the stores in Canada that they've been selling off over the past few months. They were very fortunate in Canada in that Nordstrom is planning to enter Canada, and so those leases suddenly had real value because many of them were under market and in prime locations. At some point, you run out of selling your best locations, and that's going to be an interesting question for Sears Canada.
Basically, bankers in the industry have said Eddie Lampert, the head of Sears, plans just to continue liquidating the company. There's no plans to invest money into store renovations or any of this sort of thing. I mean, it doesn't look like a turnaround of Sears is likely. Is that correct in your estimation?
That would be my opinion, yes. My opinion is that they gradually are going to raise money by selling off pieces and locations because the stores don't look like they used to look.
Now, could they get a pretty good valuation for a business like Lands' End if they spin it off, they take it public, it becomes its own entity? What's the best option for Lands' End, for example, or its automotive centers?
You know, I think the best value comes when there's a defined need for an entity that has a clear proposition. So both of those businesses have, clear propositions, and they both, have significant businesses in their own right. The key would be for them to be able to exist outside of a Sears box, because if the traffic to the mothership, i.e. the big Sears store, is declining, by definition the traffic will decline to the, to the shops in the case of Lands' End. If Lands' End is able to have independent stores, comprising a significant part of the business, that would increase the valuation.
Now, what Sears Canada is doing and selling off locations mirrors a little bit what Hudson's Bay did in selling Zellers to Target. Is that correct? There's a huge demand for real estate in Canada, and that could push up the valuation of Sears Canada. Is that right?
Well, I think it's a slightly different situation, and I'll tell you why. Because when Richard Baker took over Hudson's Bay Company a few years ago, he realized very quickly that the Bay was a fantastic asset with a great heritage that had been undermanaged for many years by the previous management team. He's done an extraordinary job bringing in top talent, led by Bonnie Brooks and others, who have really made a huge difference to the Bay. It became evident that Zellers, because it had been undermanaged for so many years, had essentially given up its market-leading position to Walmart Canada. And Zellers didn't really have a future. Having said that, what do you do with all these boxes all over the country? There was no obvious taker for them until Target decided to come to Canada. And Richard Baker pulled off the deal of the century because essentially what he was doing was liquidating Zellers in one swoop and finding a buyer to take all the leases. And he sold all the leases for just under $2 billion, which was an extraordinary deal. So he achieved two things. One is significant liquidity, and two, shedding an unwanted asset that really didn't have a place in the portfolio, because he's obviously made a decision by buying Saks to go more to the middle and upper customer as opposed to Zellers, which didn't really have a chance because it was fighting against Walmart. In the case of Sears Canada, I think much like in the US, it's a war of attrition. They're selling off their best pieces one by one. And if you go back 5 years, Sears Canada was doing north of $6 billion. Now it's doing just north of $4 billion. So it becomes very difficult. You sell your best assets, and then you have to cut overhead because you have less revenue to leverage your overhead. So you cut more overhead, then you sell off more pieces, then you have to cut more overhead. Then you sell off more pieces, and it's almost like a vicious cycle. And you really question whether the best thing to do was what the Hudson's Bay did, which I think was a real strategic stroke of genius, as opposed to what Sears is doing, which I would consider to be a war of attrition.
Thanks for joining me, Antony.
My pleasure.
And that was Antony Karabus, president of Hilco Retail Consulting. And I'm Richard Collins with the Deal Report.